Hello friends, welcome back to CEC-UGC live lecture series on management accounting. Myself Aditya P. Tripathi, I am once again here to continue our discussion on the topic of statement of cash flows. In this lecture I shall be talking about the indirect method of preparing statement of cash flow. But before moving ahead to the indirect method of preparing statement of cash flow, we shall have some small problems as per direct method of preparing statement of cash flow, and after that we shall start our discussion on statement of cash flow as per indirect method. So let us start with a numerical problem on statement of cash flow as per direct method. Suppose you are provided with the transaction and there is a need that you are required to calculate resulting cash flows from the given transactions and classify them in their respective activities of statement of cash flow. So first you have to calculate the cash flow, and then you have to classify them into their respective activity, that is operating, investing or financing. So whatever is the nature, accordingly we shall be classifying them. So the first transaction is that this company has acquired machinery for rupees 2,50,000, paying 20% as cash down and executing a bond for the balance amount. So if you look at this transaction, very simple. Company has acquired a machinery of rupees 2,50,000. Apparently it seems that there is a cash outflow of 2,50,000, which is not so. 2,50,000 is the cost of machinery, but the company has paid only 20% as cash down, and remaining is being paid via execution of a bond for the balance amount. So obviously that is not involving cash. So for this matter, this amount belongs to, of course, which activity? You need to think. I shall be telling in due course of our discussion. But by that time I reach to that analysis, that is answer, you also need to think that what is the broad activity under which this need to be classified. But yes, of course, only 20% of this total cost belongs to the cash, so we shall only be focusing upon that 20% of this total cost. Another transaction is that you have paid rupees 2,50,000 to acquire shares in a company called LK Limited, and you received a dividend of rupees 50,000 after acquisition. So company has paid 2,50,000 to acquire shares. Which activity? You need to think. And then there is a receipt of dividend of rupees 50,000 after acquisition. So inflow and outflow both are involved into this transaction. Third is this company has sold out machinery which is having an original cost of rupees 2 lakh, and there is an accumulated depreciation of rupees 1,60,000, and this machine is being sold out for rupees 60,000 only. So cutting short the story, you are only receiving 60,000, cost was 2 lakh, 1,60,000 was accumulated depreciation. It means WDV was 40,000 and you have sold out this machinery for 60,000, which means you have made a profit of rupees 20,000. So this transaction results into cash inflow, which activity we shall actually be discussing. Now let us analyze by every transaction. Transaction number 1. If you look at this transaction number 1, obviously there is a purchase of machinery, and as I told you, it involves payment of only 20% of cost of machinery, that is rupees 2,50,000. So if you calculate 20% of 2,50,000, it comes to be rupees 50,000 only. Very simple. 20% of 2,50,000 comes to be 50,000. This is your cash outflow. Then obviously it belongs to which activity? You need to understand that there is a purchase of machinery, so to our mind it should belong to investing activity, and yes, it belongs to investing activity, and under that activity it will be categorized as, it will be written as cash outflow, because you are purchasing machinery, cash is going out, so it is a cash outflow. See, in this way you have to analyze each and every transaction when you are going to prepare statement of cash flow. Then only you will be able to classify transaction according to their respective activity. So you have to first find out what is the cash payment, either it is inflow or outflow. Once it is clear it is a cash inflow or outflow, identify to which activity it belongs. Here it belongs to investing activity, will be showing it there. Moving on to transaction number 2. You have acquired shares of a company called LK Limited. This purchase or this acquisition involves a total payment of rupees 2,50,000. So obviously cash outflow. And then another question, it belongs to which activity? Operating, investing or financing? Answer is very simple, it belongs to investing activity, and here also it is a cash outflow. So very simple to understand, company is making investment into the shares of LK Limited, so there is a cash outflow, you are buying shares of this company. So cash outflow under investing activity. Moving on to the second part of transaction number 2, to which I would say it is transaction number 3 because it is another transaction. You have received dividend on shares of LK Limited and the amount is rupees 50,000. So 50,000 rupees is being received as dividend. Again the same question comes to us, it belongs to which activity? Answer is very simple, it belongs to investing activity, but yes, of course, here is a change that it is a cash inflow. So unlike previous transactions where it belonged to investing activity but it was involving cash outflow, here it is a cash inflow. So suppose if you have to move on to transaction number 4, you have sold out a machinery. Obviously, if you are selling out machinery, it should essentially be a cash inflow. You have received 60,000 rupees as sale consideration. It belongs to which activity? Machinery belongs to which activity? It belongs to investing. So whatever inflow or outflow is there, it shall belong to the same activity, that is investing activity, but yes, it is a cash inflow. Now how to show it in the statement of cash flow? This is the way you will be showing. After analyzing every transaction like this, you shall go for classify them under the head of cash flow from investing activity. Transaction number 1, purchase of machinery, amount of rupees 50,000 is being shown under bracket. Bracket indicates outflow, that you have purchased machinery, there is a cash outflow. Purchase of shares of LK Limited, rupees 2,50,000, again it's a purchase, it's a cash outflow, so amount is being shown in bracket. Dividend received on shares, cash inflow rupees 50,000 without bracket. Sale of machinery 60,000 rupees, again without bracket, which means it is inflow. Now we will have to adjust the cash inflow with that of cash outflow. Here it is clearly visible that cash outflow supersedes cash inflow. You have a total cash outflow of rupees 3 lakh, whereas only 1,10,000 rupees are there on account of cash inflow. So you have used cash in this activity. We shall be writing net cash used in investing activities, amount is 1,90,000, and the same shall go to outer column of cash flow from investing activity, that is rupees 1,90,000. So my dear learners, it is very simple to prepare statement of cash flow as per direct method. You have to essentially find out the cash transactions and then identify to which activity it belongs, put them there and find out the value. If we move on to question number 2, another question in front of us, you are required to calculate resulting cash flow from the given transactions, and again you have to classify them into their respective activities in statement of cash flow. 512% debentures of rupees 100 each converted into equity shares of equal amount. It means we are talking about convertible debentures. These debentures have now been converted into equity shares. So obviously there is no cash transaction. So essentially we would not write anything into the statement of cash flow because we shall only be dealing with the cash transactions as I told you at the very outset. 10,000 equity shares of rupees 10 each issued to supplier of machinery. Again, you bought machinery and in return as sale consideration, what you did, you issued equity shares to the company. So obviously there is no involvement of cash, so we shall not be passing any entry for it. Profit on sale of fixed assets rupees 15,000. You need to think under which activity it shall be classified. Dividend received rupees 8,000. Again think under which activity it shall be classified. Sale of goods rupees 5 lakh. Obviously cash inflow. Which activity, that we shall identify. Issue of shares rupees 2 lakh, cash inflow. Again we have to identify under which activity it should be classified. Now let us analyze. After having a look at the question, let us analyze each and every transaction. Transaction number 1. As I told you at the very outset, since it is a non-cash activity, there is no involvement of cash into this transaction. We shall not be passing any entry into statement of cash flows. So no entry into statement of cash flow. Transaction number 2. Again it's a non-cash activity, so no entry in statement of cash flow. Transaction number 3, profit on sale of fixed assets. It is a cash inflow from investing activity, so we shall be showing it as cash inflow from investing activity. Sale of fixed assets belong to investing activities category. Transaction number 4, you have received dividend. Again it belongs to investing activity because dividend is always received on your investments. So if you are receiving some return on account of dividend, in the name of dividend on your investment, it is a cash inflow, but it belongs to investing activity. Transaction number 5, again sale of goods results into cash inflow from operating activities because sale of goods or purchase of goods belongs to your operations, so it should go to cash flow from operating activities. And then eventually issue of shares results into cash inflow from financing activity, because if you are issuing shares and debentures, it is involving your financing pattern. It is talking about your financing pattern, the way you have gone for sourcing your funding requirement, that is your financing activity. So cash inflow from financing activity. So in this way, my dear learners, I tried to give you some example related to preparation of statement of cash flows as per direct method. Now we shall move on to the prime focus of the present lecture, that is statement of cash flow as per indirect method. As the name itself indicates that it is an indirect method of preparing statement of cash flow. So it is very important or pertinent for us to first have a clear distinction between the statement of cash flows as per direct method. Do remember, direct method discloses major classes of gross cash receipts and gross cash payments. So you have to show the gross cash receipts and payments under the direct method when you are following that, whereas when we are following indirect method, we have to take up the surplus or deficit. We take net profit as per profit and loss account, or we take surplus and deficit, whatever is there, into profit and loss account, and then we start making adjustment for some non-cash transactions, non-operating items, deferrals, and obviously accruals. So indirect method involves lot of you can say sensing of transactions, or you can say you have to identify that this transaction, this is the way this profit might have been arrived for, this is the way company might have declared dividend, this might have been the treatment of proposed dividend, this might have been the treatment for provision for taxation, and so on. So in indirect method, whatever surplus or deficit your profit and loss account is reporting, we start our journey from there. And then we have to make lot of adjustments, various adjustments, numerous adjustments related to non-cash transactions, deferrals, and accruals. So we have to be very much prepared for this kind of adjustment when we are preparing statement of cash flow as per indirect method. So in this method of statement of cash flow, what we do, we take up the profit figures or whatever profit or loss figures which are reported by profit and loss account. We start our journey from there. We take up the net profit as per profit and loss account, and then it is being adjusted for certain things like non-cash items, non-operating items if I am dealing with cash flow from operating activities. And then when I am saying non-cash items, I am sure that you understand a distinction between the non-cash expenses and non-cash transactions. When I say non-cash transaction, it can be it can belong to either of the category. It can either be an expense or be a source of income. So we have to make some impact, we have to actually make some adjustment for non-cash, non-operating item, and then again we have to move ahead for working capital changes. So if you look at the statement of cash flow as per indirect method, it looks like this. We have to prepare statement of cash flow like this. If you look at the very outset, again the head is the same, cash flow from operating activities. But it is not that simple as it was in case of direct method, where we were showing receipts and payments and we were doing away with the net cash generated from operating activities. We were concluding. But here what we are doing, we are taking surplus and deficit for the period and making adjustment for non-cash items, that is depreciation, which is a very popular example, one of the most popular example or the best example for non-cash items. Whenever it comes, we take up the name of depreciation. The depreciation is the best example of non-cash item. And after making adjustment for non-cash items, since we are dealing with the operating activities, if there is any transaction into your profit and loss account which belongs to, say, non-operating activities. For instance, you have received interest, you have received dividend on your equity shares, your investment. That is there in terms of cash. It's a cash item, but it doesn't belong to operating category, so it is a non-operating item. So first we have to find out the cash items, then again we have to filter that whether it belongs to operating activity or not. So when we are dealing with the cash flow from operating activities, we are on a search of non-cash and non-operating items, and we have to nullify their impact. I'll be showing you in detail the way we have to go for nullifying the impact. And I would explain you what this nullification means, what exactly we do into this nullification drive. We have to nullify, we have to make the impact null and void. We have to eliminate the entire impact of that transaction. I would show you how we are going for nullifying the impact. And then after this we go for making changes on account of change in working capital. Then we come to know about the net cash flow from operating activities. Then comes cash flow from investing activities and financing activities, and after this the steps are the same. So whether it is direct method or indirect method, broad classifications are the same. The only thing which differs here, the only point which differs here is, in case of direct method, on one hand where we were only searching for cash payment and cash receipts, and then we were classifying them into 3 activities. Here we take up the value from profit and loss account, and we have to sense the transactions. We have to sense the composition and direction of each and every transaction. I will tell you how we go for it. If you look at the format of cash flow as per Ind AS 7, the way we start, the most I would say the most complicated segment of preparing statement of cash flow is cash flow from operating activities. I would say 70% of the effort is required under this head, and remaining 30% is required for the remaining 2 activities. This is my assertion. You may give greater value to operating, or you may discount it by another 5 or 10%. But to my mind, significant effort is required for cash flow from operating activities. Now you have to move ahead with me to understand the way we shall be preparing statement of cash flow as per indirect method. Suppose I am having a question in front of me. What I would do, I would first search for net profit as per profit and loss account. Either it would be given in the adjustment, or I will have to take the value from the profit and loss account. Normally what happens, we are provided with a balance sheet of 2 years, and then some adjustments are given, and from those adjustments we take up the value of profit and loss. I always advise my learners, don't take profit after tax. Try to, cause if you start net profit before tax and extraordinary item, it is good. So take up net profit before tax and extraordinary item. Now why do we take before tax? Because if you take after tax, again you will have to make some more nullification. Now after you have taken the net profit before tax and extraordinary item, show this value into your statement of cash flow under this head. Now here comes your nullification drive. You have to nullify the impact of non-cash, non-operating item. So you will have to search in your profit and loss account, because this is the figure of profit which you have arrived at by looking at the profit and loss account. So have a look at the profit and loss account if it is available, and try to find out non-cash transactions first. Now if there is non-cash transaction, can be in either segment, either it would be in the segment of payments, or it will be in the segment of receipts. So start with the payments. So you have to nullify the impact. Now my learners ask me, sir, what exactly this nullification means, which you have been using time and again here. Nullification means whatever you have done, you have to reverse that. Just like in medical science, suppose if you are allergic to a medicine, there is some medicine which is given to you, and after administering that medicine, there is some reaction in your body. So doctor cannot extract that medicine out of you. Doctor has to again prescribe another medicine to you for healing, to nullify the impact of that medicine which has been given to you. Likewise in accounting also, we cannot go for crossing a transaction. We have to nullify the impact of that transaction. So if you have subtracted it to arrive at the profit, you have to add it. If you have added it, subtract it. So whatever you have done previously, if it is expenses, obviously you might have deducted it or subtracted it from the value of receipt. So you will have to add it, and if you have added it, which means it belongs to income category, you have to subtract it. So nullify means whatever you have done previously, you have to reverse it. You have to nullify the impact of it. So we start for searching non-cash items. I would give you some examples. First is depreciation. Depreciation is never paid in cash. It's a notional item. It's a notional payment which we try to show, which we are showing in our profit and loss account on account of provision for depreciation or depreciation. So depreciation, since it has been deducted from the profit with which we have started our journey, we have to add it because we have already subtracted it. Transfer to reserve. Transfer to any reserve is basically an on paper transfer. There is no cash involved into it. So we have to nullify, so add it. After finding out non-cash transactions, I have given you example of depreciation. It can be transfer to reserve, transfer to general reserve, or any other transaction which is having on paper transfer that will be qualifying under this category, and we have to nullify their impact. Once it is over, you have to search for non-operating items. For instance, there can be a loss on sale of plant. Loss on sale of plant, obviously it belongs to profit and loss account, but when we come at the cash flow, obviously it belongs to which activity? Plant belongs to investing activity, so it shall go to investing activity. It doesn't belong to operations. So we have to nullify its impact also. It has been subtracted, added, so it belongs to non-operating category. Now some students feel, sir, you said we have to nullify the impact of non-cash transactions. Remember, I said non-cash and non-operating item. So when we are dealing with cash flow from operating activities, we are not only supposed to deal with nullification of non-cash transactions, but also non-operating items. There can be a profit on sale of plant. Obviously it needs to be subtracted, because you have previously you have added it. Dividend paid, it belongs to which activity? Dividend you are paying, it belongs to financing activity. It should go to financing activity. What it is doing here? So you have to nullify its impact. You have to, again, if you have paid dividend, it need to be added back. Now after this nullification of non-cash and non-operating items, my dear learners, you will come to know about another value which is being called as operating profit before working capital changes. So at the very outset, what is the first step? Take up the profit before tax, then nullify the impact of non-cash, non-operating items. Once it is over, you will have to work out the impact of working capital changes. That is why we are calling it now operating profit before working capital changes. Now remember, working capital also belongs to operations, which means current asset and current liability. Current asset includes your debtors, your bills receivable, your cash, whereas your current liability includes bills payable, creditors and all. Just do remember, when you are working on working capital, don't include cash and cash equivalents here. That shall be taken care at the end, because we'll have to add opening balance of cash to arrive at closing balance of cash. So barring cash and cash equivalents, all items which belong to current asset, that shall be included here. So we take up operating profit before working capital changes, and now you have to look at the movement of each and every transaction of current asset and current liability. So at times my learners are saying, sir, how to identify which one to add, when to subtract. Some people say learn it. I never suggest that you have to mug it up. I would say you need to first understand why are we adding it and why are we subtracting it. Let us start with the current asset. You will be provided with the balance sheet figures of 2 years. So let us take example of debtors. Your debtors will either increase or decrease as compared to the previous year. So you have to take the current year's value, compare it with the previous year's value, and then find whether it is increasing or decreasing. Suppose if your debtors are decreasing, what does it mean? Your debtors are decreasing means you sold out goods on credit, and those customers, they might have made payment to you. So if there is a decrease in your debtor, it means it's a clear-cut indication that there is an inflow of cash into your business. And if it is inflow, it need to be added. So decrease in current asset. Now by citing this example of debtors, you can understand the same logic applies for each and every item of current asset. Under the category of current asset, wherever you find decrease in current asset, without giving a second thought, you have to simply add it to operating profit before working capital changes. But what if it increases? If decrease is added, increase need to be subtracted. So opposite to it, if it is there, the treatment should also be opposite. So decrease in current asset you have to add, and increase in current asset you have to subtract. Now since current liability, now coming to current liabilities belongs to which category? It is opposite to current asset. So whatever you have done with the current asset, opposite to that shall be the treatment for current liability. So decrease in current asset is being added. So remember, increase in current liability will also be added. Why increase in current liability? For instance, if your creditors are increasing, what does it mean? Your creditors are increasing means there must be some increase in your purchase. Purchase means without paying money, goods are coming to your business. So increase in current liability is actually acting as cash into your business. Without making payment of cash, you are actually enjoying the cash position. You are enjoying the benefit of cash. So add increase in current liability and decrease in current liability need to be subtracted. After making this adjustment, what you will come to know? You will come to know about operating profit after working capital changes. So we started with operating profit before working capital changes. Once we have worked out on working capital changes, this is called as operating profit after working capital changes. Once it is done, do search for income tax payment. If there is any income tax paid, reported into your question, just you have to remember that you need to show it as an outflow. You have to subtract income tax paid from it to arrive at cash generated from operating activities. So 70% of your activity is being performed once you have prepared statement of cash flow, and under that you are done with cash generated or used in operating activities. Once it is done, the next step is cash flow from investing activities. Very simple. If there is a purchase of asset, it is a cash outflow. Sale of asset, it is actually an inflow. Interest received on investment, again it is a kind of inflow. After working out, adjusting the inflow and outflow, you will come to know about cash generated from or used in investing activities. Next step is financing activities. The same process. It is very simple because there is no non-cash item, non-operating item. There is no working capital changes need to be incorporated here. You have to simply go for issue of equity shares, inflow. Redemption of debenture shares, outflow. Dividend you have paid, it is basically a kind of outflow, and then you will arrive at cash generated from or used in financing activities. Once it is done, you have to aggregate the cash generated from or used in all three activities, A plus B plus C, and you will arrive at net increase or decrease in cash. Once it is calculated, very simple, add opening balance of cash into it to arrive at closing balance of cash and cash equivalent. So my dear learners, in this way we prepare the statement of cash flow as per indirect method. This seems little complicated to you, but I'm telling you, be very sure that it is not that complicated as it seems. It is only about the practice. In the next lecture of mine, we shall be attempting some questions on this statement of cash flow as per indirect method. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.